Hello and welcome to KYC. I'm Anushi Vakharia and the company on today's radar is Max Estates. Now, why Max Estates? That's the key question, because if you just look at what's happening with the real estate sector, it's been one of the worst performing index this year. There have been concerns in terms of how the volume trends are shaping up, how the pricing growth is expected to be, and particularly interesting is the NCR market. So bringing all this into picture is something why we want to look at a Max Estates. Now, the key question here is as to why we want to talk to them. Firstly, about the pricing and the volume trends which are shaping up in Delhi NCR. And this is especially after the first half where we are looking at, wherein if you just look at the top 15 developers, they have seen some bit of that decline in terms of where the volumes are, but majority of them have remained steadfast on the launch pipeline, acceleration in that particular area for the second half of this year. Along with that, we'll also be looking for the outlook in terms of how the pre-sales and collection growth has been for the company, considering it was a muted H1 that we have seen. But for FY26, the company expects a 6,000 to 6,500 crore worth of pre-sales. So how is that achievable? What are the key launches that we should be looking out for? Is something that we want to see. Debt trajectory with these upcoming launch pipeline is something that we should be watching out for. Currently, the company has a net cash position. Is that expected to sustain is the key question here that we should be seeing. Along with that, margin differential between JDAs as well as outright purchases is something that we want to be focusing on. This is with how the model is shaping up across these two segments is what we are seeing. So these are the key elements that we are seeing for Max Estates. Along with that, the commercial business outlook is something that we should be watching out for. Sorry for that. But that's the all 5 questions that we want to see what's happening with Max Estates. But let's understand the company in a better sense. Firstly, just about the company, it was established in 2016. Now, it's essentially a real estate developer in the Delhi NCR market, and they just got listed on exchanges in October of 2023. So if you are looking at that, they have a portfolio size of 18.5 million square feet. And this is mainly across the Delhi NCR market that we are looking at. Apart from that, what we are looking at is that the total GDV, that's the gross development value that we are seeing till date, is stacking up to 7,500 crore. This is in the residential space itself that we are seeing. And if you look at the total leased area, that stands at 1.2 million square feet. Now, that's the kind of potential that we are seeing from the commercial business itself. So overall portfolio remains on the healthier side. So let's understand how we can differentiate it across these segments which are there. If you look at the residential project mix, that is about 50%. Commercial projects contributing to 23% of mix or so, while mixed use, which is a mixture of both of these segments that we are looking at, has about 28% of contribution to the overall segment mix which is there. Moving forward to how the overall development status is for these upcoming launches and even the current projects which are in focus, they've delivered about 8% of it so far. This is about 80 million square feet of land parcel that we are looking at. Under construction area includes about 35% of mix, while under planning and under acquisition is 50% and 7% respectively as well. So this is the development status that we are seeing so far. But what's interesting is the commercial business outlook, in which the company is also increasing its focus on. So just for that particular reason, they have now a strategic partner in terms of New York Life, which is New York Life is acting as the exclusive real estate partner in India for this Max Estates and focus in this. If we just look at the funding so far, 1,800 crore is the kind of funding that they've received from this. So this is the commitment till date that we've looked out for them, and the company has a healthier portfolio in terms of how the commercial business is expected to shape up going forward. If you just look at the total gross development value as well in terms of how the residential is expected to be, 17,000 crore is the launch pipeline that we are looking towards, and a couple of launches are skewed towards the second half of this year. This is after a muted H1 that we are looking at. Now, if we just take the GDV in account, 21,000 crore is the kind of size that we are seeing in terms of the overall revenue potential as well. And the company does plan to add about 3 million square feet of projects going forward as well. So this is the overall perspective that we have on what a Max Estates is currently doing in the NCR region. But that was all about the company, but let's understand how the key metrics are shaping up and what are the valuation metrics that we have used so far to give this a better judgment. So you have your income statement, you have your operational metrics, your balance sheet, as well as cash flow. So we'll be looking at all of these key parameters. Along with that, return ratios is something that we should be seeing. Shareholding, this would be an interesting one, considering it's a recent listing that we are, not a recent listing, but it's just 2023, it marked its debut in terms of stock exchange. Along with that, we also will be looking at street cred and outlook going forward for the company. So we have 8 of these parameters so far. Let's start off with income statement. Now, do note that before I just talk about the income statement numbers, it's important to note that it is a real estate company that we are looking at. So, if you just see the performance in terms of how the fiscals have shaped up, there is lumpiness in terms of the quarters because revenue recognition is based on percentage completion or project completion. So you will also see those 2 to 3 year old projects now being recognized in terms of whether revenue is concerned. So to just look at P&L as a key indicator for the performance going forward is not the right way. So we have to look at the income statement as well as key operational metrics to get a better sense for all of these real estate companies. So if you take the revenue in consideration, 32% is the kind of CAGR growth that they have showcased over these last 3 fiscals. This is with a margin profile of around 27 to 29% that we have looked in FY24 and 25. In fact, in FY22, they had a margin of around 45%. Net profit has seen about a 74% of a CAGR in these last 3 year periods itself. Coming to the first half numbers, they reported a 24% of an uptick in terms of where the revenue was concerned, while for EBITDA was flat at 24 crore, while margins stood at 24 crore versus 24% versus 29.5% last year, and net profit stood at 19.8 crore versus a loss that we'd seen last year. So this is in terms of income statement that we are looking at. While the 3 year CAGR remains on the healthier side, it's because of the lumpiness in terms of how the revenue and the profit will shape up is a key reason as to why we've given this a neutral rating for now. Coming to the key operational metrics, the 2 important aspects that we should be focusing on is something like a pre-sales growth, because the booking values would indicate to the kind of revenue visibility that the company would have forward. So from FY24 to 2025, we are looking at a substantial jump in terms of where the booking value is concerned. 5,300 crore is the figure that we are seeing, and the management expects a 6,000 to 6,500 crore of pre-sales figure by end of FY26. Now, this is interesting considering the first half, they marked about 370 crore itself. So it's the 3 key launches that are planned this year. On the basis of that the management is optimistic on in terms of where this FY26 guidance is concerned. So in terms of launches also, last year they planned about we looked at a launch addition of around 5,700 crore worth of GDV, that's the gross development potential. This year they expect to do more than almost double of that at 9,500 crore, which would also aid that pre-sales growth of 6,000 to 6,500 crore that we are looking at. So we've given this a thumbs up rating on basis of that, because the key operational metrics remains on the healthier side. Now coming to the balance sheet, that's the third metric that we are focusing on. Here we are looking at a substantial increase in terms of how the equity has been from FY24 to 25. This is also on account of the QIP which took place, leading to that dilution and increase in that equity share capital base. So that's one reason why we are looking at a divergence in terms of where the FY24 and 25 metric is concerned. Borrowings also has seen an uptick in terms of the FY24 and 25 numbers, and this is on the back of the company's plan on acquiring new land parcels for launching them going forward. So we are looking at an uptick in that, but cash in bank has managed to keep that borrowing number in check. Majorly, if you look at FY24 figure, there was enough cash balance as well to take care of these borrowings that we are looking at, and the management also has remained focused on keeping its borrowing number, net debt to equity number, below the 1 ratio that we are looking at. Currently, it does have a net cash position, so it is on a positive side that we are looking at. But this is a metric that we'll be seeing forward, considering that there are a lot more launches planned throughout the year, so we've given this a neutral rating. Now, coming to cash flows is again a neutral is what we are looking at. Now, cash flows from operation FY25, that stood at 225 crore. FY24 also we looked at a positive positive figure, but in H1, there was a build-up in terms of where the inventory numbers were concerned. On the basis of that, we're looking at a negative figure of 305 crore. Net cash flows were also about 18 crore of a downtick is what we are seeing. So we are giving cash flows also a neutral rating, considering that FY24 and 25 was on a healthier side. Now, return ratios, if you just look at the divergence between FY23 and 24, compare it with FY25, you're looking at a substantial differential, and this is on account of the company also selling a stake in its subsidiary, which has resulted in that increased profitability boost that we are seeing. So that has aided those margin numbers to climb upwards to 12 to 14%. Is this sustainable going forward is a key question to ask. Hence, a neutral rating for return ratios is also what we are looking at. Now coming to shareholding, it's a healthy set that we are looking at. Promoter stake has remained at 45% or odd. So this is post a dilution as well. From 49.5%, it has come down to 45%. But FIIs, a huge mix is what we are looking from them as well. The stake has remained at the likes of 26 to 27% or so, while DIIs have also substantially picked up stake from March 24 to 25. 6% is the kind of the number that we are looking forward to, while public holds about 21% of stake in the company. So this is clearly a healthy sign that we are seeing for the company in terms of how the promoter holding and even the other investors are there. So we've given this rating a thumbs up. Coming to street cred now, if you just look at the 1 month, 6 month performance, we have seen correction across these different time frames, especially in the last 1 year, which is also in line with what's happening with Nifty Realty. If I'm not mistaken, even the index is down about more than 11 to 12% this year. Year to date, if you just take that in account, it is in line with what's happening with the overall Nifty Realty space as well. It's seen about a 14% of a decline in this 1 year period itself. So emphasis would be whether there would be recovery in the next period onwards with these valuation multiples now correcting. Because if you look at their performance since their listing in 2023, it's a 76% of an upside that we are seeing. So while post FY24, we have seen a decline in terms of where the shareholder wealth is concerned, we've given this rating a thumbs down. Lastly, coming to the outlook forward, now this is an interesting part that we are seeing. The company has a healthy launch pipeline of 9,000 crore. This includes 3 major launches which are expected in the second half. This includes Estate 361 in December 2025, Max 1 in Jan 26. Along with that, there's Sector 105 in Noida, which is expected in Jan or Feb as well. So that would help that 6,000 to 6,500 crore of pre-sales number that we are looking at. Overall gross development value also, if you see, that is 17,000 crore or so. So they are expecting higher revenue potential from that particular piece of information as well. And coming to the final piece, which is the commercial business, here they're expecting an annuity rental income potential of over 700 crore in few years, and this is with expected price escalation also in the next 3 years or so that we are looking at. So this is the overall picture that we have for Max Estates for you. If you just club all of these metrics down and see what the ratings are adding up to, we've given income statement a neutral, operational metrics on the healthier side, while balance sheet and cash flow are neutral is what we are looking at as well. Along with that, return ratios is a neutral, considering that FY25 was a particular strong year. How is that going to shape up is something that we should be watching out for. Shareholding, a clear thumbs up is what we've seen. So this all adds up to 4.5 on 8 for a Max Estates. Interesting would be the management's commentary on this. So just to discuss on how the picture has been, we're also joined in by Nitin Kansal, the CFO of Max Estates. So thank you so much for joining us. Just want to start off this conversation by understanding the industry level perspective. First half, we saw volumes across industry have been muted. So what are the trends that you are seeing so far, and what is a Max Estates position here in the market?
Just to give context, what is it? Delhi NCR market has had in the first, it has now, it can be further divided. Delhi NCR market can be divided into 2 parts. We have a Gurgaon market and Noida market. Now the Gurgaon market has been slightly, has been very strong for last few years, and now is showing signs of cool off starting from the first half. And as compared to Noida, Noida is a very supply constrained market and has got a consistent, the strength continues at the Noida market.
just want to understand in terms of the outlook, in terms of key launches which are planned for the year, overall potential that you see from these fresh launches post a muted H1. Are you on track with the 6,000 to 6,500 crore of guidance given, considering it was a muted first half that we've seen?
Sure. So what had happened in the last year, we had launched a project called Estate 360, and which we had sold off close to 93-94% in the previous financial year. In the current financial year, the remaining inventory of that project got sold. That is the sales number of close to 367 crores. It got reported in the first half of the current financial year. In the next half of the current quarter and the subsequent quarter, we have a planned launches of close to 9,500 crores across Noida and Gurgaon. The first one to come online is a project with the name of Estate 361, which is the extension of the project which was launched last year, Estate 360, in which we are expecting to do a launch of close to 4,500 crore rupees in the current financial. And in Noida, we have got two projects, one in Sector 105, a land acquired through a Noida auction, and one project called Max 1, which we had acquired through an NCLT process. So all this together, we are planning to have a launch of close to 9,500 crore rupees starting from now till March 31st. And what we are expecting is, we have given a guidance of 6,000 to 6,500 crore rupees on the pre-launch in the current financial. Since the launches are happening this year, and this is what we have been stating, is that our launches are expected from the third quarter onwards, we believe we are on track to achieve our target for the current financial.
So if you just consider the expectation is of a stronger H2, and this is on the basis of these new launches that we are looking at. So considering that, also want to understand what is the mix between sustenance and the new sales bookings?
There is no sustenance sale. As I mentioned, 360 now is completely sold. The project which we had launched in the current year, these are the current sales is 9,500 launches are all new launches, and out of the 6,500, 6,000 to 6,500, only 400 crores was the sustenance sale, and the remaining number is coming from the new sales, new launches.
So that is on the pre-sales that we are looking at. What's the guidance for collection growth also for H2? H1, we did see a dip in this particular metric, but now with these new launches slated, how will this improve?
So what we have done in the first half of the current financial, we have done a collection of 700 crores. What we do, our collection plans across all our residential projects are equi-distributed. In the first half of the current financial, we had an installment due at the project in the Noida project called Estate 128. And in the second half, we would have the collection coming from the Estate 360 project, the first phase of the Gurgaon project, which we're expecting to have a collection of close to 800 to 900 crores, which looks on track. The demands of the same are expected to be raised in the fourth quarters, beginning January, and the remaining, and we are expecting to have a collection of 1,000 to 1,200 crores coming from the new launch. Since our typical payment plans are 20% upfront and the remaining amounts to be collected over the life cycle of the project, we're expecting to make a collections in the range of 2,500 to 2,600 crores in the current project, of which around 700 has already been done, and another 500 crores is expected to come from the existing projects and 1,200 crores from the new sales.
Okay, so that is on the collections that we are looking at. Coming back to the industry, just want to reiterate, NCR outlook, is this one of the markets with highest price appreciation as well post-COVID? So with that now cooling off and volumes also coming down, how do you assess the current market trends and pricing growth thereof?
So industry, if we take a slightly longer perspective of the NCR market, so for a long period starting from 2010-11 till the COVID time, the industry had a very sluggish kind of a growth, both in terms of volume and in terms of the pricing. The inventory overhang was so huge. Now post-COVID, that overhang has gone up, and if you see from a period from 2010-11 till now, the CAGR which we are doing is not even double digit in terms of pricing of the real estate. So what we are catching up on the old period, the lost decade on the real estate side. Coming from here, what we believe is that the market has shown the growth has been tremendous in the last 3-4 years, and we might see slightly cooling off in terms of velocity, but we believe the pricing will be, if not showing the similar growth of the previous years, would be stable at these ranges.
So what's the overall business development potential also that you're targeting, considering you have an overall size of about 17,000 crore of GDP? How is execution supposed to shape up for this in the near and the medium term as well?
So what we have projected is that we are planning to have sales of close to 21,000 crores in the next 3 years, including FY26, of which we already have an inventory sellable GDV on the balance sheet of 17,000 crores. Parallel to that, we are evaluating close to 8 to 10 projects at various stages, which has a total GDV acquisition potential of close to 22 million square feet. And these projects are spread across Noida and Gurgaon, including Delhi also. We have a stated objective of doing 1 million square feet of commercial every year and 2 million square feet of residential every year. In the current year, we have been able to meet our targets for the business development by acquiring a project in Gurgaon and acquiring a project in Noida. We are focusing on acquiring. We believe that we would be able to do these acquisitions in the coming years also.
So of this business development potential that we are looking at, what's the mix between joint development agreements and outright land purchases as well? How are margins also different across both these segments?
So the difference, I think it's although our intent is to do a combination of joint development agreement and outright, but it's more a function of what kind of opportunities are coming our way. Currently, in terms, if you see the margins of outrights are more in the range of close to 40% and in the case of joint development, they're more in the range of 20 to 25%. But having said that, in the case of joint development agreements, the IRRs in both the projects are almost equal because the capital getting deployed on the JDAs is significantly less. So in terms of absolutely, the IRRs are equivalent in both the cases of outright or a JDA.
Okay, so that's on that particular piece that we are seeing. Now, give us a sense of what this huge pipeline also means. What will be the capex that are there required for this? Are internal accruals also sufficient for this, or would there be funding requirements needed? And currently, even you're looking at a net debt-free position. Will that also change to cater to these new launches?
Yeah, currently, if you see, we are well capitalized. We had done a qualified institutional placement last year of close to 800 crores, and we also have got a long-standing partner in New York Life, which is partnered with us at 49% across all our commercial assets. So as we speak today, we would have a cash on the balance sheet which is close to 1900 crores and a debt of close to 1500. This debt is further distributed across the lease rental discounting of the completed assets and a very small portion of construction finance. And furthermore, if I can amplify that, all our projects have achieved a financial closure by tying up the debt from the bank on the commercial side, and the residential side, the projects have been financially closed by the sales which we have done. Currently, we are not looking at raising any capital. We have got sufficient headroom for a planned expansion, which I had mentioned to you in the previous conversation.
Okay, so that's on the residential picture that we are seeing. Just a last question on the commercial business as well. What's the outlook here?
Yes. Yeah, if you see, we have a run rate of close to 160 crores of a lease rental income annually, and what we have projected is that the projects which we have in pipeline, we're expecting the number to go to close to 800 crores by the time all the projects are commissioned. And thus all the projects, we have got New York Life as a partner, and we have been able to achieve financial closure across all these assets.
Okay, thank you so much, Mr. Kansal, for joining and sharing that perspective on Max Estates. So that's the piece that we are looking at, overall trends in terms of what's happening with the NCR market, how Max Estates is positioned there. So just a couple of key takeaways. Firstly is the FY26 pre-sales guidance, which the company is optimistic on. It's a 6,000 to 6,500 crore of a number that we are looking at. Along with that, even the collection figures, now they want this to be in the range of 2,000 crore plus. So 500 crore worth of collections is expected in the next half as well. Along with that, what is interesting is the kind of opportunity that they've pointed out. 17,000 crore is a kind of GDV number that we're already looking at. They have 8 to 10 more projects under consideration, which is at the size of 22 million square feet. Now, currently, they have no funding requirements as such for all of these key launches which are planned out. Even the debt number would be under that below the 1x level that we are seeing. So that is also on the healthier side that we are looking at. So that's the whole picture with regards to what's happening with Max Estates. But viewers, with that, it's a wrap on this edition of Know Your Company. That's KYC. Keep watching NDTV Profit for more news and updates.